Hey guys, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. Hope you check us out there. We're really just trying to be financial advisors that strip away all the intimidation, all the scary stuff, and make it fun to learn about your dough, right? Not make it like buying Lamborghinis, but how do you legitimately grow your dough, every aspect of it, and we invest for you as well, so I hope you'll check us out there. Here we go. This one's going to be a hot topic here, right? Let's debate this for a while, and I'm not saying you should or shouldn't, but I'm looking for suggestions. Should you pay off your mortgage? Let's assume you have a 30-year mortgage, and you just want to know, should I pay it off early or not? You just bought a house, or you're going to buy a house, whatever. Let's look at it from a different point of view here. Your home is most likely an investment. A lot of people say a home is a home. It's not an investment. I'm going to live there. Well, statistically, you're going to move in 7 years anyways, or less than that. So it's technically an investment. So if your investment is returning more than it costs, that's a good investment, right? Even if you stay in a house for 15 years, whatever. If whatever you invest in returns more than what it costs you to hold the investment, wouldn't you just be okay with that, right? Let me explain. All right, here's a 30-year mortgage rate. This is a national mortgage rate at the moment, give or take a little bit. This is where you stand. It's currently sitting at 2.72%. Have a lot of customers refinancing and buying houses right now. About 3% is where you're at, give or take wherever your credit score is. If we look at the target Fed funds rate, what I'm going to do is plot the upper end of the rate. You know that the Federal Reserve plots their rate in two ranges, the lower end and the upper end. So the lower end right now is 0, no sense in putting 0 on the chart. The upper end of their target Fed funds rate is 0.25%. Stop. Before I go any further, I know that the target Fed funds rate is not tied to mortgage rates. I know it's the overnight lending rate. I did a whole video on that. This is just for fun. We're just debating. Just don't. Okay. Upper end of the target Fed funds rate. Only reason I'm showing this is to show that the Fed is currently, they basically have rates at 0 for banks to lend to each other, which trickles into lending for customers and eventually into mortgages. They have no intention of raising it anytime soon. What I'm trying to show is essentially the Fed funds rate is 0. Why are mortgages 3%, by the way? You ever ask yourself that? I'm not ranting. I actually meant to share this with you. But you know why the mortgage rate is 3%, but essentially the banks get to borrow for nothing? Why is it that they loan for 3%? Why isn't it 1%? Why is there such a big spread there? The answer is inflation. So when a bank offers you money to go buy a house, well, first they hope you pay them back, right? But they assume and know that you're going to pay them back over time. And the longer it takes for you to pay back that mortgage, the less valuable the dollar is that they loan to you. So they have to account for inflation there. That's why negative interest rates are so scary. Because if I loan you money for 30 years, I have to know that I make a little bit of money, but also I can't lose due to inflation. And so that's why you see that. Short answer. Anyway, so here's what we've got here. Here's what I want to show you. Annualized growth. This is a Case-Shiller numbers here, so these are not my numbers. This is Case-Shiller. They put it together. Robert Shiller put this together a long time ago. It's one of the most widely followed rates out there. Let's get rid of this one. Okay, so here's what we've got. We've got 2.2, let's call it a 3% mortgage rate there. What I'm going to do is back that out for just a second. Hang with me. And we're going to look at the normalized growth of the of your property, right? What is the growth rate of your real estate, right? And most people say 3%. That's probably fair. But we can look back and say, for the last 20 years, real estate has grown, total of 125%, or 4% annualized. So you bought something that costs you 3%, add in some fees or whatever, it's 3%. You're making an average of 4%. If what you own is growing more than it costs you, why do you want to pay it off? Right? It's an argument. I'm not telling you not to. I'm presenting one side. On the other side, I go, maybe you pay off the mortgage early and so you have more dollars to invest. There, you happy? I did it. Okay, so on one side, I've got a house. It's growing more, national average. I'll show the rest of the different areas in a moment. But the national average says 4% returns on my house value. It cost me 3%. This is a rare time when we're not spending a lot of money to purchase a house for the loan. So if it's growing more than it costs you, what's the hurry to pay it off? I'm just saying, you can't blame somebody for having that argument. Now, so that's the first part there. Could you take those dollars that you would have used to pay off the 3% note and invest it in the market, invest it in your business, invest it in whatever you like that grows a little bit more? Can you get a better than a 4% return? That's how you got to look at it, is if you have a 4% return on your property, but you know you can get a better return somewhere else, why don't those extra dollars go towards that and not towards the real estate? Right? I mean, it's an argument. Okay. Anyways, let's take a look a little bit further here. Keep in mind that the 4% is a national average. What we can do is break it down even further. Let's take a look. Let's go to Portland. I sound like a radio host. We got Portland on the line here. 4.63% annualized returns over the last 20 years. We got Phoenix in the mix here. 3.84. Okay, not bad there. Dallas, who's with me from Dallas? Out in Dallas, 3.42. It's not very good. Chicago, 1.98%. Okay, here's where, if you're in the Chicago area, you've got an argument to say, nope, I'm not gaining more than it cost me to keep the mortgage. Some of you are going to be different, but you get what I'm saying there. Now you've got a 3% mortgage, but you're not making 3% on the value of your property. You could even argue, is that worth buying a house in Chicago? I don't know, if you have to. Okay, moving on to Atlanta, 2.37%. Sort of surprising for me. I would have thought Atlanta would have recovered faster. See on the charts here, here's the whole housing financial crisis in here and how quickly some of these areas recovered. Oregon recovered the fastest. You got Arizona second fastest. You got Dallas third. But otherwise, anyways, you got Atlanta in here. Average growth rate over the last 20 years, only 2.37%. Let's try Miami. Where's Miami? Okay, Miami comes in the lead there, 4.72% in Miami. So you got nearly a 2% spread between what it costs you and what you make. If you're not paying your mortgage off early in Miami and you obviously have your dough straight and everything else is good, then hey, we can't argue with you in Miami. New York, that's always a hot one. Miami beats New York. New York's currently at 3.64%. You can see them all right up here if you're trying to take a look. And I think I got Charlotte. Is this Charlotte in the mix here? We've got Charlotte at 2.81 if I hadn't already clicked on that one there. So a couple regional areas just to show you that national average is definitely not something you want to focus on. Look in your area there if you can to see what your growth rate is and see if it makes sense. How about Washington, D.C.? Washington, D.C. in the mix there, 4.49. Yeah, we know things moving in D.C. We know that. Okay, nonetheless, just wanted to share that with you. It's just a way to look at it. It's just a thought. Right? What we do here with our customers, in fact, I did a class for customers on if you have to have a car loan, how do you do it? How do you finance it? What car do you look at? What age do you buy? So that no matter what you buy, you never end up upside down. Does it matter if you're upside down in your car? Some people don't care, right? But my job is to look at every single penny and ask the question, is there a better way to go? That's it. So I'm asking. If for you it's better, great. If for you it's not, it's okay. So when we look at your mortgage, do we really want to pay it off early? If you live in Portland, if you're living in Miami, you're living in, well, Dallas, if you live in Washington, D.C. and stuff, doesn't it make sense to maybe go put your dollars elsewhere because the growth of your house is already outpacing what it costs you to own it? Just, it's a thought. I know some of you are going to bash me for this, and I'm ready. I'm just sharing the data. I'm proposing a question. Nonetheless, I hope that helps. It's just a fun way to wrap up the week. You enjoy the rest of your day and your weekend there. We'll be back next week to do it all over again and take the heat. See ya.